Rihanna Whitson there. Real estate and media services business Domain Holdings has announced a net profit of $34.3 million, a rise of 50% on last year. The company, which is majority owned by Nine Entertainment, has declared a dividend of 4 cents per share and confirmed it will repay the $5.7 million in JobKeeper payments it received in 2021. CEO Jason Pellegrino says the core listings residential business has had a great bounce back after 2 difficult years.
It's been a really pleasing result. Overall, our net profit is up 66% year on year, which is sort of vindication of the strategies we've put in place to deliver on the opportunities in front of us, as well as set this business up for the future through investment. Our core listings residential business grew above market rates and is a great bounce back after 2 years of incredibly challenging performance. Our commercial and developer business has also returned to growth in the second half, and our media business has grown ahead of market. So finally, our agent solutions business, which provides services into agents, and our property data solutions, which provides a series of data insights and tools and services to a range of stakeholders across the market, also experienced growth. But overall, a really, really pleasing result.
Jason, Domain has made the decision to pay back JobKeeper. Why is that, and how will that impact FY22?
Yeah, we signalled that at the half year that it was something we were considering, but at that point in time, there was still considerable number of lockdowns, particularly if you remember in northern Sydney and the beaches. What we have learnt over the next 6 months is a couple of things. The board is increasingly confident of the strategy of Domain and the progress and the performance. We've delivered a great result over the course of the last 12 months, and also increasingly confident with the patterns of activity and listings volumes that we're seeing in a market that still is impacting COVID-related lockdowns and restrictions. What we have seen over the last 18 months is every time those restrictions are in place, listing volumes do decline, but consistently we see a pattern of them rebounding very, very sharply as soon as they're eased. With that confidence in the market and confidence in the business, we've resumed dividends, and we've decided that the right thing to do would be to repay the JobKeeper grant.
Just on those listings, we know that they've come off with the current lockdowns that we're seeing in certain states across the country. How do you expect that to impact on the business, and what are your projections for the housing market when lockdowns end? You mentioned there you do expect those rebounds to return like we've seen in the past.
Yeah, it's incredibly difficult to provide a week-on-week, month-on-month forecast because the market and listing volumes are directly impacted by COVID restrictions. What we can say, however, is what we're seeing in the first 6 weeks of this financial year is listing volumes are actually slightly up year on year. You know, they are impacted in Sydney particularly, but across the rest of the nation, we're seeing a national average of listing volumes being up. At the same time, we're seeing the same patterns of behaviour that we've seen in the last 6 months, where these listing volumes do snap back very quickly as soon as restrictions are eased.
So, Jason, how has the last year impacted on the business?
If anything, it's helped us accelerate. So in our core listings business, we've delivered revenue growth in our largest products, particularly with agents and the agent take-up at faster than market rates. So we're gaining market share on that basis. At the same time, we've taken the opportunity to take some of the sort of growth that we've seen in that business and reinvest it in new types of businesses in our transition to a marketplace where we're offering services to consumers. For example, helping them finance their properties, to protect their properties through insurance, and to services across the range. So if anything, the COVID restrictions over the course of the last 12 months have increased the digitisation of the industry, the willingness to transact through digital means, and we've seen an acceleration of the take-up of our products.
Expenses were up around 5.6%. You've also got a higher cost guidance. Where are these costs coming from?
Our confidence and willingness to invest in the future opportunities of our business. So our core listings business, the cost guidance for that business is relatively flat. A slight increase in, we're seeing some pressure on wages, particularly with technology sectors and due to the closure of the border. But overall, quite a small, low single-digit cost increase. And
finally, just on property prices, we've seen them red hot in many parts of Australia. Do you think that this will continue? The momentum in house prices will continue?
Look, there is strong demand and there is a lack of supply at the moment. And we have to realise that this is not just a point-in-time moment. This is a catch-up in a low listings volume, low transaction volume that's been in place for the last 2 years. Yes, we had COVID last year, but the prior year also had incredibly low transaction volumes related to the Royal Commission and restrictions in credit and availability. And so we are seeing sort of a catch-up. Again, I go back to the point I made before. These listings and transactions don't disappear. Most people move or decide to buy or sell because of life decisions. You know, it's births, deaths, marriages, divorces, new jobs, all those sort of things. They don't disappear. The timing might be moved around. And so what we're seeing is this rapid increase in demand at the moment and a real desire to sort of catch up on those transactions that were missed.
Jason Pellegrino, great to talk to you. Thank you for joining us.
Thank you. Thank you for having me.